Should you pay off your mortgage early, or is that money better used elsewhere? At first, it sounds simple. Pay off debt, save on interest, and own your home outright. But the truth is, this decision is more complicated than it looks. Today, we'll break down the pros, cons, and smart alternatives to paying off your mortgage early. Let's start with the upsides. Save on interest. The faster you pay, the less you owe the bank. That could mean thousands saved over the life of your loan. Peace of mind. Owning your home outright means no monthly payments, no eviction risk, and less financial stress. Guaranteed return. If your mortgage rate is 6%, paying it off early is like earning a risk-free 6% return. No stock market swings, just guaranteed savings. Faster equity. Every payment makes you a bigger owner of your home. Once it's fully yours, you could tap into that equity later if needed. Future cash flow. Once the mortgage is gone, that monthly payment turns into extra money for travel, retirement, or other goals. So early payoff can mean more security, more control, and more breathing room. But there are trade-offs. Missed investment opportunities. If you put all your money into the mortgage, you might miss higher returns in the stock market, for example, or retirement accounts. Reduced flexibility. Once you pay down the mortgage, that cash is locked into your house. Need it back? Well, you'll have to sell or borrow against it. Loss of tax benefits. Some homeowners get deductions on mortgage interest. Pay it off early and you lose that write-off. Prepayment penalties. Some loans charge 1 to 3% if you repay early. Always check your contract before making big payments. Other priorities. If you've got high interest credit card debt or haven't saved for retirement, those should usually come first. So while paying off early feels great, it isn't always the smartest financial move. So when does paying off early actually make sense? If your mortgage rate is higher than what you can safely earn elsewhere. If you're close to retirement and want fewer expenses. If debt causes you stress and you want peace of mind, of course. If you already have an emergency fund, at least 3 to 6 months of expenses. And if you've already paid off higher interest debts like credit cards. In those cases, being debt-free can outweigh the downsides. But you don't have to go all in. There are middle ground strategies. Partial overpayments. Add a little extra each month. You'll shorten your loan and cut down on interest. Refinance. Lock in a lower rate or shorter term, reducing costs without paying everything off at once. Debt recycling. Use your home equity to invest elsewhere, but this is advanced and carries more risk. These approaches give you some of the benefits without losing flexibility. So, is it worth paying off your mortgage early? For some, yes, especially those nearing retirement or looking for peace of mind. For others, keeping flexibility, investing, or tackling high-interest debt first might be the smarter play. The key is balance. Understand your goals, your risks, and your alternatives, because the best choice isn't the same for everyone. As always, time, planning, and strategy make the difference. Thanks for watching. Don't forget to subscribe for more smart money insights.